Welcome to the Capital Allocation Dilemma. Today we're diving into one of the most important and often misunderstood responsibilities in corporate finance, deciding where a firm should put its money. Think of it as the company's version of choosing between buying a reliable sedan or a flashy sports car. Both can get you there, but one might leave you broke if you're not careful. We'll explore how investment decisions shape a company's future, how tiny calculation errors can cost millions, and how finance professionals serve as translators between strategic dreams and financial reality. This is where strategy becomes real. You can have the best PowerPoint strategy deck in the world, but until money moves, it's just words. Capital allocation turns ideas into factories, software, marketing campaigns, and acquisitions. Here's a quick example. Netflix deciding to invest billions in original content instead of licensing it from others. That capital allocation decision transformed their business model and the entire industry. Remember, small errors create big swings. A 1% miscalculation in WACC might sound harmless, but a $200 million project, well, that's a few million dollars evaporating into thin air. As finance professionals, your job isn't to predict the future perfectly, it's to bring clarity when the future is fuzzy. Executives crave certainty, but the real world is full of ambiguity. Your analysis should simplify complexity, quantify the risk, show the trade-offs, and present actionable recommendations. You're not just crunching numbers, you're shaping million-dollar decisions. Think of yourself as the headlights of a car driving at night. You may not see the destination, but your work helps leadership see what's right in front of them clearly enough to move forward safely. By the end of this lecture, you'll be able to do 4 things like a pro. Apply core metrics like NPV, IRR, and profitability index. You'll be able to use market value, WACC, not book value. Remember the last module. Interpret advanced scenarios like capital rationing and sensitivity analysis. And communicate your findings clearly to executives. These are the tools that transform you from a number cruncher into a strategic advisor. So let's refresh the toolkit. Every capital budgeting decision rests on these 4 pillars: NPV, IRR, payback, and PI. NPV tells us the absolute value created, how much richer the shareholders become. IRR tells us how fast the money is working. Payback shows how quickly we recover our investment, the CFO's favorite. And PI measures efficiency, how much bang we get per buck. Remember, each tool has its place, but together they tell the full story. So let's dig a little deeper here. NPV is the gold standard. It asks, if we discount all future cash flows back today, how much value are we actually adding? For example, imagine investing $10 million in a solar plant that brings in $2 million a year for 8 years. If the NPV is $2.5 million, it means shareholders are $2.5 million richer today because of that investment. That's real value creation. Always remember, if projects are mutually exclusive, pick the one with the higher NPV. You can't spend percentages, you can spend dollars. Internal rate of return. IRR is the project's effective rate of return. It's great for telling you how fast money grows, but it can lie to you when comparing projects of different sizes or timing. For example, a lemonade stand with a $100 investment and $200 return in 1 week has crazy IRR, but it doesn't make you a millionaire. A $10 million plant with a 15% IRR might create far more actual wealth. So use IRR as a screening tool, not a decision maker. Payback period. This is the favorite metric of non-financial executives because it's simple. How fast do we get our money back? It ignores time value of money and cash flows after payback, but it does give us a quick sense of liquidity. For example, a project with a 2-year payback feels safer than one with 5, even if the 5-year project creates more total value. So use this one as a sanity check, not a decision driver. Profitability Index, or PI. PI is like the return on efficiency score. It tells us how much NPV we get per dollar invested. In a world with unlimited capital, we just pick the biggest NPV every time. But in reality, we have constraints. We have limited budgets and limited bandwidth. That's when PI shines. Think of it like picking stocks. If you only have $1,000, you want the most return per dollar, not just the highest total gain. Now, this case that we're doing this week has 2 attractive projects, but 1 capital budget. So you're going to apply DCF tools like NPV, IRR, and sensitivity analysis to determine which project creates more value for Victoria Chemicals. But beyond numbers, the winning analysis connects financial metrics to corporate strategy. And this is a hallmark of executive-level thinking. Which project would you recommend? Efficiency or expansion? Why? And what assumptions matter most? Good finance professionals don't just run numbers, they tell the strategic story behind the numbers. Whether it's TechFlow or Victoria Chemicals, your goal is to present clarity under uncertainty and confidence under constraint. So think about this. Does the board choose safer Merseyside efficiency play or the bolder Rotterdam growth option? How does each align with shareholder wealth maximization? Here's a summary of the 2 projects. The Merseyside project boosts output efficiency, lowers operating costs, and extends plant life. It does deliver strong NPV through productivity gains, creating significant shareholder value with relatively low risk. Now, Rotterdam's advantage is strategic expansion. The Rotterdam project expands production capacity and it integrates advanced polymer technology. It offers a higher potential IRR and future market reach, but requires greater upfront investment. The Victoria Chemicals case highlights a classical capital allocation dilemma. Should the firm prioritize near-term efficiency, like Merseyside, or long-term strategic growth, like Rotterdam? Understanding how NPV, IRR, and strategic alignment interact is critical for making the right board recommendation. Why do NPV and IRR sometimes disagree? 2 reasons: scale and timing. Alpha is bigger because of scale. Beta is shorter, timing. IRR assumes reinvestment at the IRR, and that's usually unrealistic. NPV assumes reinvestment at WACC, and that's more realistic. Remember the golden rule: when in doubt, follow NPV. As Warren Buffett would say, don't let percentages trick you out of dollars. TechFlow is another company similar to Victoria Chemicals, and you'll use the same thought process in your case study. And this is where we check capital efficiency. Beta's PI is 0.37 and alpha's PI is 0.25. That means beta generates 37 cents of value per dollar invested versus alpha's 25 cents per dollar. Under capital rationing, where every dollar counts, PI helps us find the best bang for the buck. Think of it like grocery shopping with $20. Do you buy the steak, aka alpha, or the value-packed chicken, beta? Well, that depends on your appetite and, of course, your budget. Here's where real-world constraints hit. The $12 million budget means TechFlow can fund either project alone, but not both. Notice if they fund Beta, they have $6 million left over. They could use that for smaller projects or innovation pilots, but the board prefers focus over fragmentation. This is a good example of how strategy, not just finance, drives capital decisions. Continuing with the TechFlow example, both projects are good. IRR is greater than WACC, NPV is greater than 0, and it's within budget. So we apply the mutually exclusive rule, pick the higher NPV. That's the alpha. But we'll stress this test recommendation to make sure it holds under different assumptions, because in finance, it usually depends is the right answer. Not all projects carry the same risk. Using one company-wide WACC for everything is like giving every student the same grade regardless of effort. Alpha's moderate risk may push WACC up to 13 to 14%, lowering its NPV. Beta's low risk could justify 11%, raising its NPV. Suddenly, Beta might become the better deal. This shows why risk-adjusted discount rates matter and why sensitivity analysis can literally change million-dollar decisions. I want to go back for a second here. Okay. This is where we put our recommendation through a stress test. In the base camp case, alpha wins. In the conservative case, higher rates, alpha suffers more due to longer life. In the optimistic case, lower risk premiums, beta shines. The lesson here is never present a single point recommendation. Executives don't expect certainty, they expect confidence in the range that you provide. The Hall of Finance shame. These are the mistakes that keep CEOs awake at night. Using IRR over NPV is the classic trap. Ignoring constraints, making those recommendations in a vacuum. Using book values, your balance sheet isn't your market reality. Forgetting the tax shield, leaving free money on the table. Each of these alone is bad. Combine them and you just turned a $2 million win into a $2 million loss. Don't be that analyst. All right, so let's land the plane here. For mutually exclusive projects, NPV rules. Risk adjustment can flip your answer. Always present ranges and rationale because transparency builds trust. When presenting to executives, lead with the decision, not the math. The math is your safety net, not your speech. So when might beta be the smarter choice? What if budget expanded? Should TechFlow fund both? This is where financial logic meets strategic judgment.